The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. You are listening to Money in the Morning with Mitch Goldberg. Welcome to Tuesday, February 28th, the very last day of February. And I know that investors are very happy to see this month go away. So let's just take a quick look at where things are. NASDAQ futures look to continue yesterday's mildly up day. Dow futures are up 72 points. S&P futures are up 7. NASDAQ futures are up 10. These are very small greens on the screen. Oil is up $1.77. That is a pretty decent size move. Oil's up to about 77.5 per barrel. Still about in the middle of its trading range, low 70s to low 80s. The 10-year yield is up ever so slightly at 3.945. While I've got you here, let's take a look at all the bond yields in real time. This is something that we didn't always do. We used to just take a look at the 10-year yield to know what interest rates are doing, and that was the end of it. But it's so dynamic now. The 1 year and the 6-month T-bills continue to hold slightly above 5%. A 5-year can be had a yield of 4.19%, 10-year 3.945%, and 20-year 4.13%. And you know, a lot of people think, well, why would I buy a 5-year or even let's say a 2-year at 4.8%? when it can buy a 6-month at 5.14%. And you'd be right to think that, except that if interest rates come down, and that, you know, next time you roll that money over into a 6-month T-bill, when they mature, you roll the money over to a new one, maybe you'll only get 3 or 4%. I mean, very unlikely you'll get a 3 or 4% yield in the next 6 months. I don't expect the Fed to be cutting rates in the next 6 months. But the point is, it's important to, what I say, ladder your fixed income holdings, your bond holdings, because while a longer term rate, longer dated bond might not be so attractive as far as yield goes compared to shorter term bonds, sometimes the shorter term bonds go down in yield after a while. Rates could move lower, and then you'll be like, I should have put more money into some longer dated bonds because those are down also. So that's how we diversify. One way we diversify bond holdings is timing, some 3 months, 6 months, 1 year, 2 year, etc. And we could also diversify with treasuries and corporate bonds. There's municipal bonds. And there's a whole plethora of mutual funds, exchange-traded funds. There's so many ways at your disposal to diversify your bond holdings that we just didn't have access to years ago. And if you're not sure about how to go about this, we could talk more about it. You're welcome to reach out to me. You can check out, by the way, moneyinthemorning.info to learn more about me. And if you want to just reach out to me for a quick one-on-one. Diversification is a strategy that we use to reduce risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. And just so you know, you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So just have to let you know those two things. I'm glad we got those two doodads out of the way. All right. So we are happy to see February end for the month. As of right now, the Dow is off 3.5% on the month. The S&P 500 is off 2.3. NASDAQ is down only 1% on the month. By the way, the Dow Jones is the only major average of the three averages, Dow, S&P 500, and NASDAQ Composite, it's the only one that's actually down a little bit on the year. So, if you just looked at the beginning of the year to where we are now, it's nothing terrible. It's still, the year is, 2023 is still new. It's just that we had such a powerful rally through January, and the major averages just were up so much, so quickly. But it was really just the bounce back, the January effect when investors took lots of tax losses, so they would sell stocks that are down. In December, with the expectation of buying them back in January after 30 days, so they could claim a tax loss and carry that forward against future gains. So when you take a tax loss, you have to be cognizant of the 30-day wash sale rule. And that means if you sell a stock, I just throw any stock out there, you sell it, you take the loss. You cannot buy the stock back until the 31st day, calendar day. Okay, or else you lose the ability to claim the loss as a tax loss. Now, if you decide you want to sell the stock and buy it back quickly because you think there's an opportunity for a trade or a bounce, that's a different story. But if you're looking to actually use a loss for tax purposes, you cannot buy the same stock back until the 31st day. You could buy right away. You could buy a similar stock or a similar fund. Let's say you sell you sell a semiconductor stock, a chip stock for a loss. You can't buy that stock back until the 31st day. But you could buy another semiconductor stock or a tech fund while you wait for the 30 days to go by. Okay. Just so you know, I'm not your CPA. I'm not a tax advisor. I don't give tax advice except for, if taxes have something to do with investing in personal finance, then I talk about it. Okay. But if you have specific tax questions for your specific situation, you really need to speak with your own tax advisor. Okay. But I'm a financial advisor for over 30 years, and I can tell you that it's not possible to talk about personal finance and investing without touching upon some of the broad and general tax issues. Like when I talk to people about putting money into an IRA or a Roth IRA, it's all about getting a tax deduction now or getting tax-free distributions down the road. Okay, so that's what that is all about. The big hero of the market yesterday was, believe it or not, Union Pacific. That's the railroad that had the spill in East Palestine, Pennsylvania. The CEO announces he's stepping down yesterday. The stock was up about $20 a share. It was the biggest percentage gainer in the S&P 500 yesterday. Stock has basically recovered all of its losses from February 3rd when the spill happened. Today's big winners is Target. That stock is up a little bit. It would ordinarily be up more. They had a really big, just solid earnings beat and revenue beat. But they were expected to make $9.23 earnings per share for 2023. They took it down to a wide range of $7.75 to $8.75. So good news at Target. Inflation eating into margins. In other words, inflation for a retailer is a problem when they can't raise prices anymore. As long as a retailer could raise prices, they could maintain their margins during inflationary times. But what they see is the inability to raise prices because it's hurting volumes, and they see consumers as stretched. So not a particularly bullish call of the consumer, not terrible, but it bears watching. Costco will report their earnings Thursday morning, and we're going to be watching those very closely also. So we had Home Depot, Walmart, Target, and then Costco. And I think those companies will tell you everything you need to know about the state of the consumer. The state of the consumer is, shopping for bargains, a little weaker, a little stretched, and really impacted by inflation. Is it enough to get consumers to stop spending, to cause a reduction in sales and production in this country, to cause the economy to slow down, which is what the Federal Reserve is trying to do with interest rate hikes? That remains to be seen. We've got our next big employment report coming up on March 10th. So that'll be just such a big key number to determine, the next couple of months, even after that. Okay, so we hear the music. We're going to talk about staying motivated in a down market in a turbulent economy. We're going to talk about personal finance. We're going to talk about paying off debt and a leveraged life. You're listening to 103.9 FM, LI News Radio, Money in the Morning with Mitch Goldberg. Please stick around. We'll be right back after these brief messages. This is, by the way, a live show. We're getting into some other topics besides just what's happening in the stock market right now. Just suffice it to say that inflation, interest rates, that's what it's all about. And if it sounds, and I sound like a broken record and everybody else talking markets does, because there's really not much else going on. When you're getting 5% plus on a 6-month and 1-year T-bill, you start to think, I can get a pretty decent return that helps move me closer to my goals without the risk of this horribly annoying, pesky market that never shows any signs of strength, or fleeting signs of strength. So it's not a bad way to go, and for the right goals, for the right client, it's not an out-and-out recommendation. It's for your situation, based on your situation. And if you're in an IRA, your 401k rollover, and you're getting 5%, if you can earn 5%, that's like in a tax equivalent yield. That's like 8% or 7%. For a lot of you. And you know what? If you can earn 7 or 8%, without the risk of investing in the market for a portion of your funds, it is very compelling. And as someone who preaches diversification, I do believe that bonds are an important part of a portfolio. Not necessarily for someone who's 25 or 35 years old, but definitely it was when we start hitting our 40s. We start to add bonds, a bond component to a portfolio, and we start to add more and more of that as people get older. Now, I'm not saying that someone under 35 or under 40 can't have bonds. I also want to make sure that people have a portfolio that they could live with. There is just some people, if they see a lot of downside in their portfolio, they're going to sell everything, they're going to sit in cash, and they're going to miss the upside of the market long term. So in some cases, we have to invest more conservatively based on an investor's risk tolerance. So if you have a lower risk tolerance, you would invest obviously more conservatively. The idea is what I want you to think of is this. I want you to take the most risk you can that doesn't, send you over the edge into selling everything because you can't take the risk anymore. It's a very fine line. So what we wind up doing is we err a little bit on the side of caution because it's really tough to know exactly what somebody's breaking point is as far as selling everything because their account is down. But it happens. And as much as we're told that long term the market goes up, the major averages have always recovered, there is no guarantee that it happens again in the future. It could take 10 years or more for that to happen. If you remember when the NASDAQ peaked in the year 2000, it took 15 years for the NASDAQ to get back to its previous high. Now, how many of you could wait 15 years until you finally just say, I'm giving up. I don't want this anymore. But for those of you who keep investing regularly in your 401k or however you invest, during that 15-year time frame, when you do get back to even, you've made a whole lot of money, and then we go on to new highs, and you see your net worth just expand greatly. That is the number one reason to stay motivated as an investor. So it's one thing I like to address is staying motivated with your personal finance and with your investments. Look, staying motivated is it's like anything else. You have to constantly reinforce why sacrifice today is worth benefits in the future. That is what personal finance and investing is all about. Okay, it's not money in, money out. It's money in, invest, save, emergency fund, and then money out down the road. But you kind of have to become, in my opinion, somewhat obsessed about your personal finance. Like, do you look at your checking account every month to see what went in, what went out? Do you look at your on your app, whatever app, the Chase app, whatever app you're using, do you look at your spending every day on your credit cards or Amex, your debit card? Do you look at this every day? Do you kind of fuss over it? I find for me, for my personality, I look daily. Now, some of you might think that's too much, but I'm just telling you, that's my own personality. Maybe for you, it's every other day. Maybe for you, it's once a week. Maybe for you, it's once a month. I'm not saying it's a healthy thing to look every day, but I have kids. I have me. I have a business, so I look every day. I look at money in, money out. But you've got to be somewhat obsessed about it, and you've got to reinforce that goal. You have to do that reaffirmation of like, why am I doing this again? Why am I bothering for this? And I'm telling you, once you start to get some momentum, you will find that it's a lot easier to keep going. And when you get that emergency fund set aside and you start to get a comfort level with your life and you start to see some of the stress in your life go away, it's a good thing to have, and it's a good thing, it's a wonderful thing to get used to. Now, I know this message I'm telling you is not for every one of you, but it's for enough of you. And, staying motivated is important. And this is why people give up on New Year's resolutions, because the motivation goes away. Or because people have too many resolutions, too many things that they have to motivate themselves on. It takes too much mental energy to stick with, and everything falls by the wayside. But I'm a huge believer in staying motivated in whatever your goals are, and if you need help in personal finance, no financial advisor or money coach can do that for you. You have to be your own cup of coffee, and you have to stay motivated. And there's one of the ways that is a very big help to stay motivated is to do something called pay yourself first. Whereas whatever you get in your after-tax money, your money that comes into your checking account, direct deposit from your earnings, we have a way of our lifestyle growing into that number. So if you get a 10% raise in a year, somehow your lifestyle will grow into that. Now, yes, there's inflation also, but just all things being equal. So if you take money out first and that goes directly into your retirement plan, you learn to live without that money. And if you can set aside immediately, let's say whatever it is to build your emergency fund, If you don't have one yet, you need to do that. But do that the day you get paid. Open up another savings account and just move the money on the app directly into another account. A lot of you can have your direct deposit paycheck. You can have that split up and go to more than one account also. I don't know if you know that. And if that's something that you feel would be beneficial for you to do, then by all means do it. But the financial order of personal finance is always an emergency fund first, because if you don't have an emergency fund, you can't rely on your earnings to pay for everything, because your earnings are already taken up by all of your regular expenses. And then you have to rely on your credit cards. But if you rely on your credit cards and you have more than one emergency at one time, you could max out your credit. You could have a late payment. Your credit card balances, lines of credit could be withdrawn by a credit card company, and all of a sudden you are SOL. So it's so important to stay motivated. You've got to remind yourself of what you're trying to do every day. And we have a tendency to get into like this groove in life where we stop. So it's got to be consistent. The music is here. I wanted to talk to you about paying down debt using the snowball method or the avalanche method. We'll do that tomorrow. And we'll talk about buybacks. Okay, stock buybacks has been in the news a lot lately. That's it for today. I'll see you tomorrow. I hope you had an okay commute getting in with the little bit of snow that we had. And you're listening to Money in the Morning with Mitch Goldberg on 103.9 FM LI News Radio. Please stay tuned for more homegrown programming. And thanks so much for your time. Have a great day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views